Hey everyone, today we're speaking to Kushagra Kumar, who's a director in the CF&B, the Consumer Financial Services and Business Services team at Avendus, where he focuses on the financial services sector. Kushagra was also my manager in my first job at Ernst& Young, where I was for 2 years, and it was a great experience working with him. So thank you so much, Kushagra, for taking the time out today.
Pleasure is mine, Karthik.
Yeah.
It was a pleasure working with you back then as well.
Yeah. So Kushagra did his MBA at IIM. So just during your time at IIM, how did you think of sort of like career opportunities and like which sector you particularly wanted to join after that?
Actually, when I started MBA, I was fairly fresh without any work experience, right? And at that time, you generally go with the flow. So at that time, the flow was that the first choice is usually investment banking, then the second choice was consulting. So I would say I went with the flow. I didn't know which career path will be the best suited for me. I ended up interning with another investment bank before my final placement. So I liked the work. The work was fine. It was with Bankam back then, Bank of America. It wasn't Bank Bofa Merrill yet. It was Bankam. I liked the work. I enjoyed doing financial analysis and adding my two bits on which companies to focus on and so on. So I would say I went with the flow rather than having a clear idea of what my career goals should be or what should I focus on. That is something I would not recommend to most of the youngsters. I would urge them to do a lot more research as compared to me on where the paths will lead to, how it will shape up. Obviously, being in IIM Ahmedabad, I had the advantage that a lot of people senior to me or from earlier batches had gone to different investment banks. So I had some perspective, but not a very deep perspective.
Understood. And then sort of like, how much did what you studied in your IIM sort of prepare you for what is actually required on the job? Because I think compared to a lot of maybe other services sectors within financial services, investment banking requires like a really strong understanding of financial analysis and all of that, which compared to maybe some of the other sectors. So how much was like your learning on the job as you started out at an entry level and your internship versus sort of what you were able to study in college?
What we studied in college in corporate finance particularly was fairly relevant. That subject teaches you the basics and apart from what you learn in accounting. So accounting and corporate finance are, I think, the pure basic courses that you need. Anything else, like we had courses on futures and options and specialized trade financing, etc., etc. Those things are not so relevant in pure investment banking. Maybe if you actually go into F&O trading or if you go into related fields, it may be relevant. But I would say you have to focus on corporate finance and accounting. These are the two most basic courses that you need to focus on. What helped me in which also was, I actually joined the FIG practice, Financial Institutions Group practice in JM Morgan Stanley. And I had fortunately done a couple of courses on banking and financial services in India. So that really helped me, but that was more out of chance as compared to, happening due to design.
Right. Got it.
And I mean, we just saw on your LinkedIn as well that you graduated at a very interesting time in 07, right before 08. So when the 08 crisis happened and maybe a couple of years after that, although India was relatively more insulated, but did you feel a shift in the way the environment was and particularly how investment banks came to be looked at before and after, or what was your general kind of feeling around that period?
So yeah, 2008 was a watershed year, right? The investment banking industry itself changed the structure globally and in India. I would say before that time, investment banking used to be the number one choice by default for everyone who wanted to get into the industry from top B schools. After 2008, people saw job losses particularly for Indian investment bankers in Hong Kong, USA, and even in Europe. So it was a bit of a depressing time. Quite a lot of the bankers, particularly in the younger pool, had to return back to India. But I think overall, what really changed, though, in my mind, was the compensation structure for particularly in the bulge bracket firms. So earlier, your bonuses were significantly higher as compared to your fixed salaries. After 2008, the salary structure across the top US bulge bracket firms changed, and the fixed component became a little higher, and the bonus components went much below. So even if you were a star performer, it didn't matter that much. So people who really wanted to slog it out and earn 200% bonuses, that was out. That was history. So that changed. I think the quality of talent more or less remained the same. Also because the number of students which were getting hired from Indian campuses, that decreased significantly, particularly for US and Europe roles, and also for Hong Kong roles. So the quality of talent flowing to Indian investment banks remained the same. Uh, Supply and demand, I would say. The supply was still the same. The demand has decreased. Or maybe the supply had also decreased somewhat, but the demand had decreased significantly for foreign bulge bracket firms. Yeah.
Understood. So I think your first main sort of role where you spent a significant amount of time was at JM Financial, after which you moved on to EY, where you spent a really long amount of time as well. What would you say in terms of like particularly domestic banks in the country? How would you compare sort of like their deal flow to bulge brackets? How would you compare their deal flow to sort of bulge brackets?
So even back in 2007, you would need to have international bulge bracket firms as well as domestic firms on a deal, because you needed to market it to FIIs, DIIs, as well as domestic HNIs and retail investors. The question only was, how are these stacked? Okay, so who are your top picks in international banks versus who are your top picks in domestic banks?
Right.
I don't think that logic has changed significantly since then. If you see the number of banks which are on an IPO now, it has probably gone up as compared to 2007. But yeah, I think the leading bulge bracket iBanks will still be there, and leading bulge bracket domestic iBanks will still be there. So Kotak, Axis, which was IIM back then, and JM, etc., used to be the top three picks back then, are almost the same top three picks as of now as well.
Right.
So deal flow wise, it hasn't changed much. What I'm seeing has changed significantly in the last 2 years, particularly, or last 1 year, is the tech and digital deals which are coming to the market, where the role of these global banks has become significantly more attractive, significantly more chunky roles they are getting. But that's also because Indian domestic institutions are still sort of becoming used to digital companies. They still don't know how to price these assets that well. So they are sort of followers. But if you look at something like a Paytm IPO, you can see that majority of the institutional demand, or more than 95% of institutional demand, was FII. Domestic institutions just didn't participate. That also shows some kind of maturity, that domestic institutions are not just followers of the herd. They have their own thesis, they have their own theories around it. Yeah, so I would say, both sets of investment banks, foreign as well as domestic, remain relevant and will remain relevant going in future as well.
Got it. And just for the benefit of the viewers also, generally investment banking tends to be a fairly broad-based term. It could refer to just pure M&A transactions as well as capital markets, as well as on the credit side. If there is a transaction to be had, or if a sponsor wants to raise leverage, etc., the investment banks would kind of help you find investors on the other side as well. So, it'll just be helpful if you could walk us through, like, what are the key differences in skills, particularly that, or in your experience, how have you straddled between the three, and which are the ones that you perhaps enjoyed the most, or where you added more value? Generally, I think that'll be helpful to kind of get a handle on.
Sure. So I'll sort of bifurcated between debt and equity markets. Okay, so the debt market in India is fairly shallow in the sense that anything below AA plus is very, very difficult in the market to execute. And therefore, the deal flows and the fee pools are relatively less if you compare it to broader economies in US or Europe. Having said that, that market is still large, but it's a balance sheet play in India. So the role of advisors and accordingly the fees that you can make on pure advisory basis is less. On the equity side, it's very different. The market is very deep. The number of transactions and the types of transactions are also quite varied, and accordingly the fee pool for pure advisory work is quite high. In terms of what you need as an advisor on both sides, whether on debt or whether on equity side, on the debt side, you need to understand the interest rate cycles more. The understanding of credit in India is not that deep because we don't go below AA plus, as I was mentioning earlier. So really, you don't have to take a credit call in as far as DCM transactions are concerned. In ECM, the role of pricing, the role of the type of investors, how many investors, how should the deal be structured, and so on, become far more relevant. So the skill set that you need for the ECM transactions are far more complicated, far more complex as compared to DCM transactions. And if you take this argument a little further, then on M&A transactions, pure corporate mergers and acquisition transaction, the skill set becomes even more complicated. So, in terms of skill set, the progression I would say is DCM probably requires the least amount of skill set in terms of Indian market, then ECM, then private equity syndication, then M&A syndication.
Got it. And just the way the market has evolved in India, at least on the advisory side, we haven't seen a lot of action, I would say, on M&A versus, I would say, in the last decade or so, the private equity side has really picked up and a lot of funds have come in, and generally there is a lot of action on that side. But how would you compare these two, if you could just deep dive between a private equity raise versus an M&A, and any particular reason why corporates in India have generally stayed away from pursuing acquisitions very aggressively as compared to maybe a US market, which is on the other end of the spectrum perhaps, but still M&A has been fairly muted in India.
So, when I was in college, my corporate finance professor used to tell us that every M&A is an acceptance of failure to grow organically. Okay, so you generally do M&A because you are not able to grow organically. That holds true in many situations. And India is a growth market. So, organic growth for corporates hasn't been that tough. And therefore, the need for M&As have been relatively less. Obviously, there are distress M&As which have happened in the market, large size deals which have happened in infra, real, and steel and so on. But Indian corporates are really not pushed towards M&A because of any particular reason. Okay, so they are growing well, they are getting growth capital at fairly good prices. Sometimes you feel that the growth is overpriced in India and so on. So as of now, I don't think there is a tearing need or a tearing hurry to do M&As in India. But as we continue to see more and more capital inflow, as we continue to see more and more companies mature and therefore finding difficult to find growth avenues, you will see more M&As across sectors. And that is bound to happen. I think it's just a matter of time. Growth capital obviously has been chasing India like big time, right? And now with China going out of equation or China becoming less attractive for growth investments, capital is flowing to India like never before. I think this year, the capital flow to India has already surpassed that of China, which is very, very new. So, which will continue. I think first you will see capital accumulation and then you will see M&As.
Okay. Got it. And I think investment banking is like an interesting job in that sort of the skill set you require significantly changes from a junior level to a senior level, where at the junior level, there's a lot more focus on like your technical skills. And by the time you reach a senior level, such as yourself, you're already building on those technical skills, but a really important portion of your job is the networking, the sourcing. So how does someone sort of like organically develop those skills or like go about building that network for sourcing? And at what level should that sort of start becoming a factor that they start focusing on?
So I'll answer the last question first. At what level? At every level. Okay, because networking is sort of central to what an investment banker does, right? Purely if you see it as a career, purely if you see as value add to the whole process, the biggest value add an investment banker brings to the process is knowing both sides, right? So you know what this asset can be priced at and how should this be positioned, right? These are the two largest value add you bring to a process, investment banking process. And for that, obviously, you need to have strong technical skills and you need to have a great networking with both sides, the capital providers as well as the consumers of capital. Networking skills you have to build early in your career, right? And some people feel that it will come one day, magically it will appear. It never happens like that. As an associate, as a senior associate or as an AVP, you have to start building networks. You have to start communicating with your counterparts in various deals and just keep hearing them out, and you will keep getting good ideas. You will keep getting sense of where the market is. You will keep getting information which is not available in public domain, right? And that's how you build your networks. Obviously, your role changes, which is obvious. But what you need for the role, what you need for, let's say, when you become when you are like 10 years in the industry and you are supposed to originate deals on your own, what you need for that stage needs to be cultivated early. It is not going to appear all of a sudden. And whether your firm pushes you for it or not, you need to start building relationships. You need to start investing in relationships early on.
Right.
And just from a point of sector focus, and I think generally in India, we would see two types of, I would say, two sort of different paradigms that you can almost kind of see, where at the one end of the spectrum, where maybe like bulge brackets, because of, sometimes manpower constraints that they have or just the headcount, etc., they tend to be more sector agnostic and a much more leaner team where they would focus only above a certain threshold, and maybe perhaps that's how it works for them. But increasingly, a lot of the mid-market and specialized domestic boutiques tend to be very sector focused and razor sharp, and often win mandates of large transactions also within that sector, some more often than not beating bulge brackets. So in your view, how does that strategy play out as a professional who's starting off their career? You've obviously focused on FIG, as you mentioned from the start, and that I'm sure has kept you in good stead, because FIG tends to be extremely technical, and if you've not spent enough time, it's very easy to get lost. So how do you think candidates should kind of straddle that between choosing sector focus versus being agnostic and focusing on your large transactions, so to say?
So in terms of large players, in terms of bulge brackets who don't focus on any segment, but who have senior bankers who focus on maybe geographies, who maybe focus on certain 3 or 4 sectors together. Because what I've seen is that it's not completely sector agnostic at, let's say, bulge bracket either. It's just that one person may be covering 3-4 sectors in one go, as compared to far more sector specialization at either domestic firms or mid-market focused firms. I think the way to look at it is ticket size, actually, as of now. Okay, because let's say if I'm focusing on deals above $500 million size in, let's say, private equity market, the number of deals that you get to do every year, or the number of deals in the market every year, is fairly limited. And with some probability, you can potentially say that, okay, these are the 20 accounts that I want to focus on. Okay, and therefore target these 20 deals only. Okay, which is what the bulge bracket foreign banks do. That approach cannot work in mid-market. That approach probably can't work in deals at, let's say, $100 million size. Right. At that size, if you want to play, you have to have deeper domain focus. You have to have a network which is fairly deep within corporates of that size, because growth in India, as we were discussing, is generally fast. So something which was just a $50 million check last year can be $200 million check this year. So therefore, it's a factor of ticket sizes. In terms of career and in terms of whether you should focus on sectors early in your career, my answer will be no. While I had done it, it was more out of happenstance rather than choice. I just happened to join the FIG group rather than being part of a non-sector specific team. What really helps when you are not focusing on any sector is that you acquire technical skills which are across segments. Okay. So, you start thinking more in terms of, if food companies trade at this EV/EBITDA, should a dairy company trade at this EV/EBITDA, right? Or if, let's say, if a manufacturing company in this segment trades at this kind of EV/EBITDA, should a SME manufacturing or should a auto comp manufacturing trade at this kind of EV/EBITDA? So, you start getting that sort of perspective, and that is very important for a banker, because many a times you will get newer companies, newer segments, newer sectors, even within your own sectors that you are focusing on. And then you will have to answer this question because you will be doing that sort of deal for the first time in your life, right? So it becomes important to have that broader perspective. Where I faced issues was, when you started looking at newer segments, newer sectors, then you had to broaden your horizon and, try to get the same answers basis different data points. So yes, my suggestion will be to avoid being sector specific early in your life. What usually happens is people generally, somewhere around when they are vice presidents or when they are 7-8 years into the sector, into the industry, they start having preferences for segments that they love, okay, or sectors that they naturally find more attractive, and then they get deep into that segment. And that's how many of them develop a segment focus, develop relationship in that segment, and so on. But that should be the natural way rather than being forced into a silo at the very beginning. So at the beginning, it's better to be diversified.
Understood.
Yeah.
Yeah, I think me and Amar also have started out in FIG teams and then after that picked up sectors. But just not like particularly on financial services, like it's been both of our experiences that compared to most other sectors, this is a sector that someone cannot just like pick up a company for the first time and get an understanding of it, which is not the case, for example, for like a standard consumer company or packaging company where you can form like a skeleton basic view of that company without having looked at the sector in detail before. So for like NBFCs, insurance, banks, AMCs, so on, at what point does someone like need to pick up the very specific subsector knowledge? Is it, do you want them to like know it before they're joining at an entry level, or is it more of like an on the job learning?
I think it's more on the job learning because, both of you are aware that accounting is so difficult so different in all financial services entities, whether you pick an insurance company or an NBFC or a bank. Accounting is very, very different from the way it is done in other segments, right? So the way you will read a financial statement for a consumer company or a packaging company versus that of an NBFC, very, very different. You really can't apply the same matrix. And we don't really expect people to come with that knowledge because whatever they would have learned in their MBAs or their CFAs or CAs will be very different. They would not have, most likely wouldn't have dealt with an insurance company for sure. Less likely to have dealt with an NBFC or a bank. So it's really not expected of them. On the job learning will be good for them. As you rightly said, once you understand, it's all about understanding of corporate finance, right? And unfortunately, financial services, the matrices, the corporate, the way of looking at ratios is all very different from what you would do in other real world segments, right? I'm sure it's the same with digital economy as well, with the digital companies as well. The kind of matrices that you look at are very different, right? So we really don't expect entry level folks to have a view or, have a deeper understanding of these segments or the way accounting is done or the way key ratios should be analyzed. We really don't expect that.
Got it. Yeah. So I think it'll be helpful to dive in more into like sort of the recruitment aspect of the entire process. So just in terms of like EY and Avendus and a lot of the other very large domestic banks are some of the outliers in the investment banking space where they have a lot of pre-MBA candidates and they're willing to hire people at a pre-MBA stage versus a lot of the bulge brackets, for example, only look at post-MBA people as well. How do you sort of see the differences in the candidatures between pre-MBA folks and post-MBA folks? And do you require the post-MBA people to have like a different skill set at an entry level from the pre-MBA people?
Not actually. On ground, the biggest difference you see is between work-ex people and the non-work-ex people. So people who come with a work experience in any segment, in any sector, they are a little less fresh. They require a little less hand-holding. So that's the biggest difference in my mind. In terms of skill set and educational background in pre-MBA versus post-MBA, I think the biggest difference comes in the understanding of corporate finance. Okay, pre-MBA candidates are not that hands-on because they may not have worked on so many projects while they were studying, or they did not have that kind of friends and classmates who were working on different aspects and discussed corporate finance with them. So that is slightly different. But if you ask me how much time does it take for a pre-MBA candidate to pick up to the same level as a post-MBA candidate, if both of them are hardworking enough, it's probably 5-6 months. After 5-6 months, a pre-MBA candidate is almost as good as a post-MBA fresher.
Right.
Got it. And just to kind of double click on this slightly little more, in India generally the structure I think has been, and now it's changing slowly, but I mean if we just go back 5 to 7 years back, typically also the way the MBA is structured in India, where IIM ABC, you don't necessarily need to have work experience. So a lot of the bulge bracket banks typically hire at the analyst level from these schools, so there is no room to go below that, and therefore they don't really hire out of undergrad. And versus in the US, where right after undergrad you hire as an analyst, and then after your MBA, and that MBA is also slightly more different, where people spend 4-5 years working and they hire as an associate. So just the pool in India is relatively shallow of pre-MBAs. But how should somebody who's just out of college and wants to kind of work before getting their MBA approach investment banking, given the recruiting is pretty unstructured and the pool is relatively small? As Karthik was mentioning, perhaps a few outliers like EY or Avendus and some of the larger domestic banks would even consider taking analysts, and that also I think is not a very structured one where you go to campuses and recruit and day zero, day one placement, etc. happen. It's more an informal network, or sometimes through headhunters, etc. But generally for candidates, how would you advise them? And maybe if you can specify if somebody's an engineer versus somebody's a CA or just a commerce grad from like a top tier college like an SRCC or an LSR, how should they really straddle the industry to kind of get some experience before they move on for the MBA?
Aman, that's a very loaded question, because I would say you are bang on. There is no structured hiring program across most of the investment banks for graduates who are not MBAs, right? And everything is unstructured here. What I have seen, the maximum pool of candidates who have not done MBAs but are working in investment banks have actually come from back offices and middle offices of large investment banks. So whether it is Deutsche, JP Morgan, or Citi's sort of back office or mid office, who are servicing their Europe desk or US desk and so on. And if they are good guys, they pick up the skills in 6 to 9 months, okay, and then they appear in an interview at Avendus or UI or somewhere else, and then they are picked up. So that's the easiest way for BTech graduate from one of the top colleges to get into it. Obviously, it takes about a year or more for them to transition from that mid-office role to a front office role in Avendus, EY, or the domestic investment banks. But I think that is by far the easiest and the shortest route. Any other route is far too unstructured to comment on. Whether you will get in, whether you will have the right connections, whether you will fly through the interviews, very difficult to say. So in terms of probability, I will suggest most candidates to go for that route. Try to get into a good mid office or back office of any of these large global banks. I understand they have 2 months or 3 months of training in the beginning, which really prepares them for future. And that training is really helpful for someone like in Avendus or EY or others in terms of the skill set that these candidates acquire. So that's there. In terms of LinkedIn or other outreach or whatever unstructured outreach you can do to potential investment banks, I don't think that really helps. You really need a very strong outreach to get your foot through the door. But of late, yeah, I'm hearing that this analyst program, people are usually happy with the results, and people are usually happy with the analyst that has been hired from all these mid offices, back offices. Uh, so I see a great potential there. Probably some of the investment banks, particularly the domestic ones, may start a analyst program which is focused on, let's say, IITs and SRCCs, etc. So that's a definite hope.
And how should like potential candidates think of an MBA as? Is it something that is they use as a mark to sort of more easily get into the industry, or if someone hasn't done an MBA and potentially has some work experience, should they be looking at an MBA as sort of like a requirement to move ahead up the ranks, or is it not particularly a requirement?
MBA that way is, definitely helpful. Okay. And as far as entry is concerned, it is definitely helpful.
Right.
As far as career progression is helpful, what you need to analyze is whether 2 years of MBA or 1 year of executive MBA versus one more year in the industry. How does that pan out? Okay. In comparison, if you ask me, if you're doing well in your career, then it doesn't matter. 2 years of MBA in an Indian B school is not going to change anything significantly. If you are going for a global B school, then obviously things are very different, and you may get into a different ball game altogether, a different sort of investment banks altogether, bulge brackets most likely. I think that is the most defining comparison they have to do as to what they want to do. If they are doing well in their career, that's the biggest question they have to ask. If they are not doing well in their career, then obviously they must think about changing something, right? And an MBA will be a good change. But yeah, I've seen candidates who have decided not to do an MBA because the payoff didn't matter.
Got it. And just picking on that on exit, right, and kind of switching career tracks. So generally, I think what would be useful is just to understand the skills that you pick up in IB at least junior levels, just the rigor with which you do it. What are the typical paths that people can look to exit? I think in the past, I think like a natural progression has sometimes been to move to junior roles on the buy side because they require complementary skills and then you build on top of that. But what would you suggest would be some of the more unconventional ones that you've been seeing of late, whether it's joining startups or joining early stage companies? And how much do you think the skills that you pick up in IB become relevant in those kind of setups as well?
I think over the last couple of years, the maximum attrition that we have seen at analyst and associate level in the industry are actually going to startups, not going to either compete or to buy side. Buy side roles are limited, and therefore, the chances of you getting them are not as high. However, the number of startups and the number of well-funded startups have continued to rise significantly over the last couple of years. And that trend will continue. So I think people will find a good exit to all these well-funded startups. Well, that will be a good route if you ask me, because there the skills that you have picked up in investment banking will continue to remain most relevant. Most of the associates and AVPs who have left investment banking and have joined startups are generally part of their corporate development or their M&A team, right, where they are actually taking sort of buy-side calls, something similar to what they would have done in a private equity firm or in a large corporate. Okay, what makes the startup roles more interesting is the ability to accumulate wealth at a faster clip. So whether it is through ESOPs or whether it is through, base salary revisions, that is definitely somewhat of an upside in the last couple of years that these startups are offering over what the domestic or sometimes the bulge bracket IBs are offering. In terms of other exit areas, yeah, some of them have started, but startup is not for everyone, and particularly for people who have just worked for, let's say, 2-3 years and are not very much up the curve on their relationships within the investing community or their understanding of how capital raising is done or how businesses are set up. how much time does it take to start a business and to scale it up, I don't think it is very relevant for those people to actually jump into startup of their own. Okay, probably it's best for them to wait a little more, 4 or 5 years down the line when they have a deeper understanding. That may be better. But yeah, exit paths from investment banking now are far more diverse as compared to, I would say, 6, 7 years ago. 6, 7 years ago, from investment banking, you could only think about buy side or some of the large corporates in their corporate development or M&A teams. Now there are far more opportunities available.
Right. And just having spent a lot of time in the industry, I think you'd be the perfect person to answer this question. What would be sort of like the two main pros that you see of working in investment banking, and maybe two things that potential people thinking of getting into the industry should keep in mind or be wary of?
So the biggest two positives are learning. So you learn a lot. The industry is such that it pushes you to learn every day. Learning on a deal, outside the deal, learning how people behave, learning how counterparties negotiate, etc., etc. That is very high in investment banking. So anyone who enjoys the steep learning curve will definitely enjoy investment banking.
Yeah.
In terms of the second greatest positive, I would probably say financial security. But what you can make, given if you are hardworking, if you happen to be in a good team, is significantly higher as compared to what you will make otherwise in a corporate life or in a startup life, right? So those are the two biggest positives. The two biggest concerns that I will say is that it's not a career for everyone. It requires a lot of dedication. It requires a lot of discipline and a lot of perseverance. So it's definitely not for those who can't give in, let's say, 16, 17 hours every day. And that also, you have to give it on your own volition, all your own wishes, right? Because you have to produce quality. It's not only about quantity. You have to produce quality work. So everyone should analyze whether they are cut out for that kind of work, whether they should do something like that, whether it fits with their own value system.
Right.
That the other negative I will say is that it's largely a cash-based economy, or you don't create long-term value. You get paid well, you get good bonuses, and you continue to do it every year. But if you stop working your ass off, will you continue to get those? The answer is no. Unlike, let's say, if you created a startup which is doing well, which has scaled up well, you can someday decide to hang your boot off and you'll still be fairly happy. Money will still continue to hit your bank account. Here, it's not the same. If you are looking for really long-term value or something that you can create from 0 to 1, then again, this is not the industry.
Got it. No, makes sense. Kushagra, we just wanted to ask you a few questions on like the financial services sector.
Sure.
Just given the fact that I think me and Aman also really think of that as sort of our favorite sector, and you've worked in it a lot. Just given we've had two large IPOs in the last 10, 15 days in that sector, both of them sort of tech focused companies. Do you really see technology as something that can actually be applicable to all of the subsectors of financial services? Me and Aman have a lot of conflicting discussions on this point, but some aspects of lending, for example, is India at a stage where really technology can be applicable in a real significant way, not really like fringe improvement of operations or something across all subsectors?
I think across all subsector is going to be very, very difficult. Okay, because financial services, if you look at it from one perspective, is just like a consumer service, right? The guy needs money for something, whether for a short duration or for a long duration, or the person needs to cover risk, whether for a short duration or for a long duration, or whether he needs to invest. So basically, there are only three kind of financial services: investments, risks, and credit, right? In all of these three, from a consumer's point of view, there is a large tech angle to be played. Okay. But the question deeper question here will be, are you sort of a funnel from manufacturers to consumer, which is where the big tech and fintech will play different roles? Or are you a manufacturer of these services? On the manufacturing side, I think scale has a very distinct advantage. And for companies in India, particularly on the digital or fintech side, that scale is quite some distance away. So, it will probably be 5-10 years before you will see anything of scale on the manufacturing side, whether it is about manufacturing of credit or manufacturing of insurance or asset management.
Right.
On the distribution side, you already have Policy Bazaar, which has shown scale, which has already sort of gathered 90% plus market share on insurance distribution. I think that space will continue to see more action. And the big tech action in India is still missing. So if globally, if you see, the big tech originates about $600 billion, as compared to that, pure fintech originates about $200 billion of loan every year. So the ratio is 3:1. The ratio in China itself is 1:6. Okay, and China is the biggest market for fintech, lending tech, digital, whatever you call it.
Right.
I think that story will play out in India because most of the consumers will be on these big tech platforms, right? So for them to originate financial services or small ticket financial services is going to be fairly easy as compared to pure fintech players. Pure fintech players will also sort of suffer from high cost of origination or high CAC. Okay. As compared to that, big tech companies will have very low CACs, so they will be able to disrupt the market significantly better as compared to pure fintech. I look at financial services in three particular formats. Okay. One format is the acquisition cost. The second format is the cost of servicing or the cost of credit. And the third format is about collection. Okay. Particularly in lending. So if you look at origination or, customer acquisition perspective, there are certain value chains which will not be disrupted. It's like new vehicles. Fintech will find it almost impossible to get into that value chain because most of the dealers will continue to remain offline, continue to have significant presence offline, and where banks and captive NBFCs will continue to rule the market. But if you look at something else like short-term personal loans or short-ticket, low-ticket personal loans, there is no value chain to be penetrated. It's a complete open field, and anyone with digital reach and low CAC will win that game. So there you will see digital players winning the game. So you are right. It will be different for different segments. My sense is that short-ticket, short-term loans will see a lot of disruption from digital. But higher ticket long-term loans will see far less disruption. And it also sort of underlies the fact that digital systems will actually bring in efficiencies. Underwriting and manufacturing is still fairly efficient in India. So as far as efficiency is concerned, that can be brought only in where the cost of origination or the cost of servicing is very high, which is at the short-term, short-ticket loans. Long-term, long-ticket loans will see far less disruption.
Both of us largely agree that it's not like fintechs are going to come and disrupt everything and all banks are going to go away in any hurry. So I think BNPL, for example, is like now everyone's doing embedded finance and everyone's getting into it. So those are perhaps more trendier things that will be interesting to see how it plays out in the slightly medium to long term.
Right. No, I think BNPL is very early in India because BNPL still has to evolve from brand pays to merchant pays. That journey still hasn't happened in India, which is already happened in some of the developed geographies. Okay, once that transition happens for BNPL, then you will see a different form of BNPL emerging. As of now, in BNPL, it's all the brands paying. So I don't think there is much to be said there. It's not even a merchant credit; it's a brand credit as of now.
Yeah, and also I think in the US credit card penetration is very high, and which is why a lot of disruption is happening. So yeah, might not play out in the same way, but India has surprised with UPI as well. So we might just leapfrog cards and go straight to some sort of BNPL that works for India.
Yeah, I agree with you. India continues to surprise, particularly in the pace of innovation. If you talk to folks in Visa or Mastercard, they'll say we haven't seen any market like India ever. Something which innovated so fast and at such massive scale.
Yeah.
Yeah. I think just another question was, like, even 4 years ago, when probably I first started, we had benchmark valuation metrics for each subsector. Like, we knew that an insurance deal was going to be at X GWP, and MSMB NBFC was going to be like another X P time price to book multiple. A lot of that benchmark metrics seem to have just like flown out of the window at this point in time. So, from an investment banking perspective and maybe your personal view as well, both together, how are you really thinking about valuation at this point in time? And like, yeah,
I think what has happened, particularly on the lending side in the last 4 years, is that the premium for scale has increased significantly. So NBFCs which were smaller and were able to scale well in the last 4 years have traded at very high multiples as compared to NBFCs that grew at, let's say, 10-15% only. Okay, so the premium for growth and premium for scale is very high. And therefore, you will continue to see deal flows happening at premium valuations, particularly in segments that investors like. Similarly, for insurance, if you see, let's say in health insurance, again, scaled assets are few, and assets that are scaling up fast are getting priced fairly aggressively or fairly attractively, whichever way you look at it. So price to GWPs are increasing. So I think that trend will continue as you see more and more capital flowing in India. The winners or the people who are above average will continue to get priced at fairly high valuations as compared to other players who have not executed that well. Multiples still remain, Karthik. It's just a question of, the divergence in multiples have increased. So earlier the band was narrow. Now there are two bands, one band at the top, one band at the bottom.
right. No, exactly. Yeah. I think Kushagra, we've kept you for really long. Thanks so much for all your answers. They were like very detailed and really helpful, hopefully for everyone. Definitely for us. Yeah.
My pleasure. My pleasure.
Yeah. Thank you so much for taking on the time. Really appreciate it. Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.